Hi everybody, this is lecture 2 for week 10 and this is Friday the 4th of June. Okay, so in the previous lecture I think I have discussed about the categories of cost. Okay, so topic 6, just to refresh your memory about this topic 6. Topic 6 is a topic about the introduction to management accounting. One of the first thing that you have learned in this topic is about the definition of management accounting. Management accounting is a branch of accounting that can be used to help manager to make business decision. In topic 1 to topic 5, you have learned about financial accounting. Financial accounting is a branch of accounting that is used to basically to make accounting record, to make business record, and to calculate profit and loss. But management accounting is a branch of accounting that can be used to help manager to make business decision. The person who do management accounting is management accountant. He or she works under the manager. If manager wants to make a price decision, then the management accountant has to help the manager to make a price decision. The management accountant has to prepare analysis, calculation, etc. And there are two main reports in management accounting. The first one is budget, and the second one is the cost report. And then you have given that a management accountant works under manager. In this topic, you have learned about the function of management. So you have seen in the lecture notes, there are three main functions of management. The first one is planning, the second one is directing and motivating, and the third one is controlling. So management accountant can help managers in these three function of management. And then I think I have also explained that one of the management accounting report that is useful in these three management function is budget. Budget can be used in when manager want to plan for the business. Budget can be used when the manager want to direct and motivate, when they want to do directing and motivating activities. And also budget can be used to when management do their controlling activities. And then you have learned something about the difference between financial accounting and management accounting. Okay, and then I think in week 8 we have a Google Meet session, and I have explained about this. I have explained about categories of costs. Okay, I have explained about this. See this one I have explained during the Google Meet that we have, I think last 2 weeks. Okay, the first category of cost is related to manufacturing costs. A business has many costs, and these costs can be categorized into several categories. The first category that you have seen in the lecture before is the manufacturing cost. So the thing is like this. If somebody asks you what are the manufacturing costs, or what are the costs that a business has to pay when the business want to manufacture a product, so this is the answer. Manufacturing cost equal to direct material plus direct labor cost plus manufacturing overhead cost. direct material cost plus direct labor cost plus manufacturing overhead cost. In the lecture, I have explained the definition for each cost. If you cannot remember, you can read the textbook, and also you can watch lecture videos that I have made for in previous semester. You can go to my YouTube channel, you check the playlist. I have made a playlist for ACT3110 for previous year student. This year I do this lecture. I do the lecture related to the categories of course online using Google Meet. So there is no video for that. As you can watch video for these categories of course in my playlist for previous year students. Okay, so I just go through this one. Manufacturing costs are direct material cost plus direct labor cost plus manufacturing overhead cost. I have explained about this. Okay, and then I have also explained about this. A business also has non-manufacturing costs. Manufacturing costs are costs related to factory. Non-manufacturing costs are costs related to the management office. If you have a business, a manufacturing business, basically you will have your business has two sections. A section for management office, and another section of the business is the factory. So this non-manufacturing costs are costs related to the management office. Non-manufacturing costs can be categorized into selling costs and admin costs. I have explained about this also in the previous lecture. And then also costs can be divided or categorized into product cost and period cost. So product costs are basically manufacturing costs. Period costs are also period costs also I think period cost equal to manufacturing cost. Why we call this cost as product cost? Because the cost will increase every time a business increase the quantity of production. So that's why we call them product cost. Period cost can be said as equal to non-manufacturing cost. We call them period cost because most of the time the cost will increase over time, over period. The cost will increase every month, for example. Selling costs and admin costs, most of the time a business has to pay them every month or every 6 months or every year, most of the time. So they are called period costs. The cost will increase according to the time. And then we have seen this question, sample question. Okay, also costs, manufacturing costs are often classified as the prime cost and conversion cost. If somebody asks you to calculate prime cost, then you know that prime cost equal to direct material cost plus direct labor cost. Conversion cost, on the other hand, equal to direct labor cost plus manufacturing overhead cost. This one you have to memorize. If somebody asks you to calculate conversion cost, then you have to know conversion cost equal to direct labor cost plus manufacturing overhead cost. And then these are the difference between merchandising business and manufacturing business. I have explained about this. And then also this one, the difference between variable cost and fixed cost. Costs, there are many costs, like I said earlier. If you have a business, you have to pay many costs. And these costs can also be categorized into two categories, fixed costs and variable costs. Fixed costs are costs that has to be paid fixed costs are costs that will not change even though the quantity of production is changing. For example, you have a business, you have to pay rent every month. You have to pay $2,000 rent. That $2,000 is a fixed cost. It's an example of fixed cost because no matter how many units you produce, every month you have to pay the same amount, $2,000. The examples of rental, what else? Depreciation, and there are many more. Another category of cost is called variable cost. Variable cost is a cost that will increase when the quantity of production is increased. So the typical example for variable cost is direct material costs and direct labor costs. For direct material, the more product you produce, the more you have to pay for the direct material. So let's say you have a soft drink business. So the cost of the direct material, let's say, is 70 cents. Because when you want to produce a soft drink, you have to pay for the bottle. The material is the bottle, the label, and also the drink. So let's say 70 cents. So direct material cost per unit is 70 cents. If you produce 2 units, two bottle, the cost is $1.40. If you produce 100 bottle, then the cost is $70. So you can see that the cost will increase when the quantity of production increase. So this kind of cost is called the variable cost. I have explained about this also in the previous lecture. Okay, this is a summary of the difference between fixed cost and variable cost. Okay, maybe we see this simple question. Which of the following costs will be variable and with respect to the number of cones sold at Baskin and Robbins shop? You have to remember, to answer this question, you have to remember what is the definition of fixed cost and what is the definition of variable cost. For Baskin and Robbins, the product is the ice cream. So the cost of lighting the store, what do you think? The cost of lighting the store, I think, is a fixed cost. Because no matter how many units of ice cream you sell, the cost of lighting is same. The wages of the store manager is a fixed cost because no matter how many ice cream the business sell, the wages of the manager is same. But the cost of ice cream is a variable cost. The more the business sell ice cream, the higher the cost. So it is a variable cost. The cost of napkins to customers also a variable cost. The more the business sell ice cream, the more napkins has to be given to the customer. So the higher the cost of the napkins. So it is an example of a variable cost. So see here, C and D are examples of variable cost. Okay, direct cost and indirect cost, very easy. Direct cost also equal to direct cost are direct material cost and direct labor cost. They are called direct cost because they are directly related to a product. When you see a product, you can see the direct material, and also you can trace how many hours workers has to work to produce the product. So just remember direct costs are direct material and direct labor. Direct material cost and direct labor cost. Indirect costs are manufacturing costs, but it has no direct relationship with the product. Indirect costs equal to manufacturing overhead because if you have a factory, you have to pay manufacturing overheads are things like the wages of the janitor, the wages of the security guards, and also the cost of uh, the cost of the material that you use during when you maintain the equipments. This cost, a business has to pay this cost when the business produce something, but this cost has no direct relationship with the product that the business produce. For example, janitor, he works in the factory, but he does not assemble a product, so he has no direct relationship with the product. So the salary of the janitor is a manufacturing overhead cost, and it is also called indirect cost. The material that the business use to maintain equipments, for example, the what they call as the the material that they use to clean the machine, to make sure the machine work properly. This material is used in a factory. The cost of this material is a manufacturing cost, but the material is not used to produce a product. So this material has no direct relationship with the product produced by the business. So that's why the cost is called indirect cost. So if I give you a list of costs, you have to know which one is direct cost, which one is indirect cost, which one is direct material, which one is direct labor, which one is overhead, which one is non-manufacturing cost, etc. So that is the thing that you have to know. And then, okay, this one. Define and give examples of cost classifications used in making decisions. Differential cost, opportunity cost, and sunk cost. Okay, these things are not in your ACT3110 syllabus. Okay, so you don't have to worry about that. So you have to know about the categories of cost here. Manufacturing cost, non-manufacturing cost, direct, what else? Prime cost, conversion cost, product cost, period cost, fixed cost, variable cost, direct cost, indirect cost. These are the things that you have to know. This one you can skip. You don't have to worry about this. Okay, I will show you the next thing. Okay, this is the summary. This is the summary. The all the categories of cost that we have, that I have explained, can be summarized in these 4 categories. Financial report, categories of cost for financial reporting, for predicting cost behavior, and for assigning cost to cost objects. For making business decision, it is not included in your syllabus, so don't have to worry about this. Okay, so this is the one of the most important thing in this topic. You have to know that starting from this topic, you are focusing on a business that produce product. In other words, you are focusing on a manufacturing business. So when you learn about financial accounting in topic 1 to topic 5, the focus is on service business. So now when you learn about management accounting, the focus is on the manufacturing business. Okay, when we are focusing on the manufacturing business, one of the things that you have to know is, for a manufacturing business, the business has 3 types of inventories. Inventories are items or products produced by the business but still has not been sold yet. Let's say you have a business, a manufacturing business that produces soft drinks. You have like orange soft drink, cola soft drinks. You produce orange soft drink, cola soft drink. So when you produce these soft drinks, you have inventories. Inventories are soft drinks that have not been sold yet. So let's say you have this business, and then at 31st of December 2021, you stop production because you want to calculate profit or something. 31st of December is at the end of the year, so you stop. So you want to calculate profit, you want to do your accounting, financial accounting record and something. So when you stop at the end of the year or at the end of the accounting period, you will have 3 types of inventories. First, see here, finished goods inventories. Finished goods inventories are products that is completed. You have a factory that produces soft drinks, so soft drink that have been completed in the production process, but you still do not sell this product yet. So these are called finished goods inventories. And also at the same time, you will have work in process inventory. Work in process inventories are products that are partially completed. When you stop your production process at 31st of December, maybe there are drinks. The drinks are ready, but you do not put the drink in bottle yet. So this is an example of work in process inventory. Or you will have drinks that has been bottled, but you do not label these drinks yet. You do not put label in this drink yet, and also this drink has not been put in boxes yet. So this is also an example of work in process inventory. Work in process inventories are partially completed products. And also you will have direct material inventories. So if you have a soft drink factory, when you close your factory at the end of the year, you will have sugar, flavor, bottles, labels, etc. These are direct materials. They are also inventories. So that is the thing. That is for a manufacturing business. So when you prepare a balance sheet for a manufacturing business, under the current asset, you have to show the inventories, and these inventories have 3 categories: finished goods, work in process, and material inventories. Okay, now when you want to prepare an income statement, when you want to prepare income statement for a manufacturing business, you have to use this format. Okay, this is the format of income statement for a manufacturing business. First, you have to remember what is the basic format of income statement. Okay, income statement is a report that shows whether the business is making profit or loss. In topic 4, you have learned that the basic format for income statement is revenue minus expenses. That is the income statement for a service business. A service business does not have inventories because a service business do not sell products, so it has no inventories. But for a manufacturing business, the business produces something. So the business has inventories. So the format of the income statement for a manufacturing business is like this. Sales, which is the revenue for a manufacturing business, and then you have to minus cost of goods sold. Cost of goods sold are costs that the business has to pay when the business want to produce its product. So the format for the cost of goods sold is like this: finished goods inventory minus plus cost of goods manufactured, and then you will get a number, and then you have to minus finished goods inventory, and then you will get the cost of goods sold. So in this example, the finished goods inventory at the end of the year is $60,000. Cost of goods manufactured are cost that the business has to pay to manufacture product. In this example, the cost is $290,000. And then the finished goods inventory is $62,500 in this example. So the cost of goods sold is $287,500. The sales minus the cost of goods sold, you will get an item called gross profit. In this example, the gross profit is $78,500. And after that, you have to minus the expenses. Expenses can be divided into two categories: selling expenses and admin expenses. In this example, the total expenses equal to $35,000. So net profit for this business, or net income for this business, is $78,500 minus $35,000 expenses. So the net profit or net income equal to $43,500. Okay, this is the income statement for a manufacturing business. You have to know this. You have to know how to prepare this. Okay, so see here, to calculate the cost of goods manufactured, see here the red arrow here. You have something, you have to do something when you want to calculate the cost of goods manufactured. To calculate the cost of goods manufactured, you have to prepare a statement or a schedule. It is called schedule or statement of cost of goods manufactured. Okay. Okay, this is an example. Okay, this is the format that you have to use when you want to calculate the cost of goods manufactured. When you see the term is cost of goods manufactured schedule or statement. So cost of goods manufactured, and then you can imagine this statement shows the cost of goods manufactured, the cost to manufacture the products, the cost that the business has to pay to manufacture its product. So, and then you remember the categories of cost that you have seen in the previous slide. What are the costs that a business has to pay when the business manufactures something? The costs are direct material costs plus direct labor costs plus overhead costs. So, when you prepare the cost of goods manufactured schedule, these are the costs that you have to put in this schedule or statement. See here, the format of this cost of goods manufactured schedule is like this. First, you have to show direct material, and then you have to show the direct labor costs, direct material costs, and then direct labor costs. And then the third cost that the business has to pay to manufacture product is the manufacturing overhead cost. See here in this example, the manufacturing overhead costs are the depreciation of manufacturing equipment, indirect manufacturing labor, indirect materials, miscellaneous plant overhead, plant utilities, property taxes and building. These are the manufacturing overhead. The total manufacturing overhead is equal to 790,200. So direct material cost plus direct labor cost plus overhead cost equal to manufacturing costs incurred, $1,648,200. Okay, and then after that, after you have added these three manufacturing costs, you have to add the beginning, the WIP inventory, and then you minus ending WIP inventory. After that, you will get the cost of goods manufactured number. In this example, the number is 1,617,600. So when you want to prepare this income statement, say this income statement, when you want to prepare an income statement for a manufacturing business, you have to prepare the cost of goods manufactured schedule first, or the statement of cost of goods manufactured first. You get the number and then you can prepare the income statement. If somebody asks you, prepare income statement for a manufacturing business called company XYZ. So you have to know the step. The first step is you have to prepare the cost of goods manufactured schedule first. After you got a number from that schedule, then you can prepare the income statement. How to prepare the income statement? You follow this format. Sales minus cost of goods sold. You will get the gross profit. After that, you minus the expenses. You will get the net profit. That is the way. I have prepared a video about how to I have made a video about how to prepare income statement for a manufacturing business, and also how to prepare the statement of cost of goods manufactured for a manufacturing business. I will share with you the video so that you can see how to do that, to do this thing. Okay, so thank you very much. This is the end of topic 6. I will do not forget to write your name and metric number in the comment section. Also, that will be taken as your lecture attendance today. Thank you very much.